they miss the understanding, okay, what can go wrong? I don't chase stocks, that's not what I'm interested in. So owning a business is the core of what I do.
So you invest pretty internationally.
Yeah, from an American perspective, pretty internationally, yes.
Maybe it's kind of embedded this this pessimism or something into my being as an investor.
I would say 95% of people that are now investing should not be investing because they don't understand what they're doing.
Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin, and we are back again with another interview of sorts. I'm sitting down today with Dr. Sven Carlin. Sven runs his own YouTube channel here on YouTube, a finance YouTuber, with a career over a lot of different areas geographically and also in terms of companies. Just from reading online, you can see that he's worked at Bloomberg, he's taught in Amsterdam, but now these days he's running an independently run research platform, shows videos on YouTube to help teach others, and I guess is a competitive spear fisherman from what you shared with me. I didn't know that was a passion of yours.
Yeah, I was born next to the Mediterranean Sea, so fishing was always in my blood, and it just continues there. So
my family's from the east coast of Canada, so same thing. There's a lot of fishing over there, and I myself am not very good, but I do enjoy it every now and then.
You're better at YouTube, so I think it's better.
Yeah, I appreciate that. So I wanted to hop on a call with you today and chat, to continue the conversation about investing and hear stories from people with a wide array of backgrounds in the field. And you're one of the few people I've ever met with a PhD in finance or investing. So I just wanted to start off before we kind of get into that, which I will pick your brain on that side of it. Why don't you share a bit about your YouTube channel and kind of the videos that you post, kind of the topics you cover and that sort of things for people who might not be aware of your channel?
Well, I declare myself as a modern value investor. So we passed the price to book values and price earnings ratios from Benjamin Graham. So more into good businesses with the moat, margin of safety. So a little bit more modernized. And I post videos on focus on stock analysis, modern value investing, and how does value investing fit the current environment. So we also discuss the Fed, the environment, also if someone asks about the tech stocks and the value investment perspective on that. So for example, to all new viewers, I'm not invested in Tesla or something like that.
So kind of traditional value investing philosophy, I guess.
Slow and steady, let's say.
Yeah, and I guess to kind of expand on that, could you explain, you mentioned, you call it modern value investing. For people who might not fully understand the differences between growth and value investing, could you explain that idea a bit further?
So growth is an essential part of value because we look at the future cash flows, and if those cash flows are increasing, that's even better, of course, from an investment perspective. Mm-hmm. At first, value investing was, okay, this building was 1 million. If I can buy it for $500,000, then I wait for the value to increase to 1 million and then I sell. That is core value investing as Benjamin Graham started it. But now it's more about cash flows. And here is the difference between the modern growth investing and normal growth investing. Most growth stocks don't have any cash flows. They are in need of constant capital to just survive and to maintain their business, so there are no cash flows. I also want a growth stock that has cash flows, which means value, and this is the main distinction, I would say.
Yeah, that's a good point. I think oftentimes, and I'm certainly a culprit of this as well, but oftentimes we like to label certain stocks as being a growth or a value stock. And, typically speaking or traditionally speaking, people would say, well, a value stock doesn't have to be one that's growing, it's just one that's cheap. But, you raise a good point that value investing doesn't mean you technically avoid growth stocks. It just means that you're cognizant of how much you're paying for that growth stock. And
if you look at Berkshire, it has been growing at 20% per year over the last 50 years. And thus, extreme growth, but it's the best value stock out there, or it has been for the last 50 years. So value and growth go together. You just need to find growth with a margin of safety. That's then real value investing.
Right. Makes sense. I guess I would lead into the next question of what attracts you about value investing? What is it about value investing versus, say, someone who maybe more speculative approaches to investing? Why value investing over other schools of thought?
I think it's more about owning. I like to own a business and then receive the benefits that the business produces. Since I was a kid, I would look at the shops, there's real estate, selling houses. Oh, if I would own that house, how much would I get from renting it? And the same principle is applied to now owning businesses. So I don't chase stocks. When I buy something, I don't expect it to go up 50% in the next 12 to 24 months. I like what I buy, and I am buying because of that. If the stock price goes lower, I'm even happier, because then I can reinvest my dividends and own more of the thing I like. So that's the main difference. Owning a business versus speculating, momentum trading, derivatives, options, whatever there is that's mostly gambling on what, or the greater fool theory, what somebody else will pay for the same thing later. That's not what I'm interested in. So owning a business is the core of what I do.
I think too, it's easy for a lot of beginners and for investors as a whole, really, to look at stocks and think of them as, just price tags or something that its only value to you is the price that you can buy and sell it for. But if you think about what investing is at its fundamentals, it is, like you mentioned, owning a business. It'd be the same as if you mentioned going to stores and looking around. That's kind of what investing is, really. You're window shopping different businesses and deciding what you want to put your money into, what companies you want to own as a shareholder. It's not just about, oh, well, I bought it for 50 and sold it for 60 in a week's time. So that being said, I'm happy I speak to a lot of people who, go to different schools of thought. The first person I actually interviewed on the channel was Patrick Boyle, who's a quant investor, which kind of is different from value investing, focuses on factors and that kind of aspect of it. And his approach is very research intensive. It's a lot of comparing variables and things like that. And I wanted to hop a bit into the research you've done. So you have your PhD, and I was quickly looking. I looked through the paper that you have published, and it's, if I'm not mistaken, it's a risk model on the Croatian stock market. Is that correct?
Yeah. So for my PhD, you have to upgrade when you do an academic research. You have to upgrade it on the existent knowledge. So I said, let's create a model that best describes what happened on the Croatian stock market from 2004 to 2013 when I got my PhD. So it's a short data span, but it came out to 280,000 data points. And then I analyzed every line of accounting statements from 80 companies and tried to develop the best model that explains the risk of investing and the potential reward. And of course, you compare that to the Fama French model, all the other models that have been already implemented and tested, and then you get awarded your PhD. And my PhD showed that the longer term data you check, the better are the results, which is pure value investing. As we say, if you look long term, then your investment results will be in line with the business results, and that is what investing really is. And I think my lines went to explaining 36% of the stock market movements in that period, which was much better than the beta coefficient that explained 5% of that.
Right. Yeah, I think the beta coefficient is kind of one of the first things you learn in invest. Like if you go to university or any sort of program for investing, it's one of the first things that's highlighted. And for people who don't know, it's I wouldn't. It's not a correlation variable, but it's sort of, to bastardize the definition. It's how a stock moves relative to the market. So a lot of people view it as, it's a covariance measure, but it has to do with how, if the market is moving a lot and your stock increases by more than the market, you would have a beta over 1. If it moves less than the market, it would have a beta under 1. But I think a lot of research has come up against kind of the beta coefficient, or at the very least, it's a very limited model. It's kind of oversimplifies a complex concept of risk.
It is very beautiful. It's a beautiful academic model, but it explains less than 5% of the factors impacting stock prices going up and down. And if you look at something that explains less than 5%, it's not really worth much from an investing perspective. Even if it's academically methodical, it's really beautiful.
Right. Well, and I think, there's nothing wrong with having an academic model. And at the very least, I would say that beta coefficients and all these other academic models, you have to understand them to understand where we are today with a lot of models and things like that. But yeah, certainly, in terms of a single variable, it is limited. And you brought up FEMA and French as well. Could you explain, again, same thing for viewers who aren't familiar with that? I believe it's a 5-factor model.
It was first the 3-factor model,
first
then
3,
expanded
and
to
then
5
kept adding
factors.
more. Yeah. Could you explain a bit about that?
So let's focus on the 3-factor model, which is the easiest. Sure. So they tested data going back to 1926 till when they did the test. First was till 1998, and they said the market is efficient with the beta coefficient, and then they said, oh yes, but if you buy value stock and small stocks, your returns will be higher with a little bit more of volatility, but long term they have then confirmed that value and size have an impact on long-term returns. So that was the confirmation of value investing that then again changes because then the market focuses on that, then the valuations change, and then you again cannot hold to any kind of models when it comes to investing.
Right. That's an interesting point that we discussed with Patrick Boyle too, was the idea that some models, as you develop them and as they are published and are used, their effectiveness actually diminishes over time. So it's kind of, it's this tricky area you operate within where it's why it's a common kind of bit of shared wisdom, I guess, that, if you were to find the secret to the stock market, you shouldn't tell a soul. That's kind of the mentality and the reason.
The mathematician guy, Simmons, he doesn't say what they do and how they did 66% over 20 years. If he would say it around the world, then he would not do it. That's simply so.
It would fall to 5%.
Yeah.
Exactly. So out of curiosity, I'd be interested to pick your brain too about, so you talk a lot about your own investments on your channel and how you personally invest. I'd be interested if you don't mind, kind of diving into what your research process is. You can go as detailed as you like or as general as you like, but just, even at a high level, what's kind of your step A to Z in terms of both from idea generation to actually deciding that you're going to put money into a stock?
So I like to take a sector or a country and then simply start researching. I'm now doing every stock traded on the Dutch stock market. And then I think that I need to write an article about the business. I need about a few hours. And so I try to write a complete article from a business overview, fundamental analysis, and an investment conclusion. It's just an overview, but that gives me an insight. Okay, will I dig deeper or not? That's now the process where I am now. And then interesting companies that I really like, I put them on a list of covered stocks, and then I say, okay, every quarter or every 2 quarters I'll come back, check what's going on with the business, compare with the stock market, also learn more about the management, get a feeling about what is the market thinking, what the management is thinking, and when the stock price might be below what I consider the intrinsic value. And so I go or country. So in the last years I did Brazil, Russia, Argentina, the Netherlands, and a few other countries or sectors, copper miners, food producers, etc., etc. And so I go country, sector, and whenever you dig deep into something like that, you always find here or there something interesting. And that's what I do, and that's what I keep doing. So as Buffett says, you start with the ace, and you will find a good investment here or there.
Right. So you kind of take a top-down approach to some degree in terms of looking at the countries first and then filtering through. Is that correct?
I start with, I'm not the top down. I don't really decide, I start and then I look at everything. So it's really bottom up.
So you look everywhere, but you segment where you look at a time kind of thing. But
yeah, so it's just easier. So the list is a bit shorter. I don't know, last year I did every stock traded also on the Austrian stock exchange. So bottom up, everyone. And then from those, I looked for investment opportunities.
So you invest pretty internationally from the sounds of it.
Yeah, from an American perspective, pretty internationally, yes.
Yeah, so I'd be interested about that because I think, and you know, when you speak of Buffett and great investors like that, a lot of them, their kind of sentiment is the American economy is, you know, the greatest economy in the world, and it's very U.S. focused, and you know, I'm as a Canadian, I have no gripes against that. I invest in U.S. stocks myself, and I think most people would agree that the American stock market is one of the biggest, most developed, and to some degree the safest stock market. Most expensive too, that's true. And kind of to our points earlier, the more people you have focused on one market, the higher those valuations become. You know, it's the same idea, and it applies to the US stock market as well. So I'd be curious to hear your thoughts as to, so you kind of touched on it there a bit about US stocks, but what are your thoughts about investing internationally? Do you think most people are better served looking elsewhere?
I think everyone should be investing in what they are comfortable with. Warren Buffett was born in 1930 and enjoyed the 90 greatest years of American economy, the US dollar dominating the world with the reserve currency, with everything. Really, it was the century of the United States. So of course, and he is based in the United States, so of course he is totally for the United States. I was born and raised in Croatia, which was Yugoslavia before that, which was a communist country. So I was born in communism, then had the war, then first started investing when I was 19 in a frontier market. So you have developed markets, emerging markets, and then you have frontier markets that most of our viewers don't even know exist. So that was a frontier market, and then you start learning and you start seeing, and I'm not shy, I think, of investing also in great American businesses, but I always compare, diversify a little bit, but if I can find, I know, the S&P 500 with a dividend yield of 2%, and I can find something with more value, with 8-9%, with more upside, then the decision for me is the 8-9%. I look at the risk and what can happen in that country, and if nothing happened in the last 25 years, it's not likely that it will happen again in the next 25, and that's okay.
Yeah, I think when it comes to international investing, that's probably one thing that deters the most people. Is kind of that uncertainty. You know, I would say it's tough enough to know how to invest domestically, and then you add in kind of that added complication of, okay, now you have to learn in what could be argued to be an entire new ecosystem of rules, regulation,
language barrier.
And you know, all those sorts of things, and you know, it just adds to the complexity of what you need to know to invest. And you raise a good point of, you know, looking at the risk aspect of countries. And I'd be interested to, you know, we could probably have a whole conversation about China specifically. And I know you've actually posted a couple videos on that topic. But it's if anything else, a good example of why it's important to understand, at the very least, to know the risks that you're facing going into countries like that. So I guess my follow-up to that would be, how do you go about familiarizing yourself with different countries? I mean, you've lived in multiple places around the world, so that certainly helps compared to, you know, I've barely left Canada throughout my life, so that probably isn't a beneficial factor. But how do you get to a point where you feel comfortable going into a different country in terms of investing?
I think one thing is you need really to give it time, and then you can always start with smaller amounts of money. So I have my core portfolio, which has 5 positions, and most of my money is there, 90%. And then I also have a large portfolio that has 20 positions. And then I am looking, and then I'm putting, I don't know, a few percentage points of my large portfolio, which is less than 1% of my, let's say, stock market portfolio, into a company in Cambodia, for example. And then you own it, and only, as Walter Schloss, another great American investor, said, only when you own something, you really understand it. Then you own it for 6 months, you follow it, you start knowing how the management will react to whatever can happen, and then you start really weighing the risk and reward, and then you see if you want to put more money into the country or company, or you say, okay, it's not for me, and I'm not gonna touch it anymore, and I lost, okay, because of course, when it comes to investing, you have to always accept total loss, but if you really do good, then the upside is really stellar.
So buying the position is almost part of the research process in terms of, or at the very least, in terms of familiarizing yourself with the company.
Depends only on exposure. How big will the exposure be? Yeah, but I feel better when I own something, then I really start to knowing and following it, and then I can make, maybe 5 years down the road, a really, really informed decision about something.
Right, makes sense. And to that point, it's tough to know everything about any company that you're going into before you make the purchase decision, especially when you have something, not to say that opportunities only come once in a lifetime, but let's say you see what you believe to be a buying opportunity. You could argue that there is something to be said for, at the very least, getting some exposure and learning through the process. That's not to say you shouldn't research before you make any sort of investment. And I think you raise a good point that exposure is kind of where you need to focus that trade-off on. You can certainly buy a position that's a bit riskier that you believe that you stand behind, but being aware of where it sits in your portfolio as a whole and how much exposure to take on there, and being cognizant of the risks involved with that. As someone who is an independent researcher, so you don't currently work for a financial institution, this is stuff that's self-guided and self-managed. With kind of the pandemic and the retail investing boom that we've seen kind of come up as a result of that, what would be the stage at which you think someone is equipped enough to stock pick themselves as opposed to relying on someone else?
I think everyone should understand what stock picking is, because if we work 40 years for someone else to get money, then at least I would expect that if you work 22 days a month, you should at least spend 1 day to manage that money. So, and then the key is to understand what stock market investing is. Okay, if I invest in that business, what do I get in return? So I can compare that fund, that managed solution, that bonds, with paying back my student loan, my mortgage. Should I better buy a rental property? And then it's about comparing opportunities. And that's, again, something that the investment market lacks. And then with stocks, I think that every retail investor can focus on 10 businesses, just 10. And if they can understand 10 businesses, that can already make a great portfolio. And you can even buy Berkshire. You have Warren Buffett and company doing everything for you.
Right.
So that's also a stock picking managed solution.
Yeah, and so there are definitely companies out there where, when you kind of dive into it, they really are a financial, a fund, if you will, that it's being managed by a professional team. You could say there are fees in the sense of their operating expenses, but at the end of the day, you have a team managing, in Berkshire Hathaway's case, a holding company that is investing in a bunch of different companies, and that in and of itself is diversified. It's interesting to hear your thoughts about, and maybe it's this is coming from me who, I work on the professional side of it, so there's obviously that bias there, but I've always been very, I don't want to say cynical. Cynical is the wrong word, but very skeptical of kind of the retail interest in the sense of how much of it will be fleeting, I guess, in the sense that, you have a pandemic where people have more time to focus on stocks and things like that. And I'm always kind of concerned with how many people are sort of quick to put the cart before the horse with buying certain stocks.
I would say 95% of people that are now investing should not be investing because they don't understand what they're doing. And that will end up ugly. That always ends up ugly. Like we have had with the dot-com bubble, with other bubbles. So it's always, when a bubble bursts, it's always very, very ugly. And if people don't know what they are doing with all these specs, buying crazy IPOs, tech companies that have never had revenues or have 50 times revenues, that's just going to most likely end very, very ugly.
And so to follow up on that, what would you say are areas that people should be aware of, or I keep saying educated, but whether it be, you don't have to have a bachelor's per se, but whether it be accounting or market history, what would you say are the things that people, let's say 3 things that people need to understand about stocks before they even consider, you mentioned a lot of people like to jump into tech stocks, and I think we can both agree that a lot of people who shouldn't be in the market are the ones who, know what the company does, but that's kind of it. Like it stops kind of where, they have a product, I like the product, and that's all I need to know. What are the other things, the other aspects that people need to be aware of when they're buying stocks themselves?
I really liked your educational videos about the market and history and what can happen, because that's what I think first people miss. They miss the understanding, okay, what can go wrong? And that's why the historical examples are really, really important. Okay, this can go wrong also with my money, and that's the first step. Okay, what can go wrong? What will I do if I lose my job? I have to sell my stocks or this or that, and how do I manage that? And that's the first thing that one should educate themselves. So personally, the personal perspective, okay, what can go wrong? And then also check, okay, what do I get from investing in the business? I just hope that those investing in those crazy tech stocks know it's a gamble on the business, but also on timing, so that the business can keep up growing until it all bursts down. So I just hope that they understand the risk and the reward of whatever they do. And if you understand the risk and reward, then everything is easier if the risk materializes and also if the reward materializes.
I really like that point about learning about the history of stocks, because, and focusing on the risk side of things first. And admittedly, I started posting what I call party pooper videos, which that was kind of the whole intent of those videos, was let's at least learn the risks that you face first, and then you can talk about the exciting upside. Because too often, people focus on the upside and they get excited and then they hop into it and then find out the risks after the fact, after they've happened. But it's funny, my own interest in stock investing personally actually came from my father, he worked for a company called Nortel Networks. And I'm not sure if you're familiar with them, but they're a Canadian company that grew internationally, became one of the biggest companies in the world, and then they crashed, and it was during the dot-com bubble. So it was kind of tied to that. They were a telecommunication company, but that telecom bubble is very much tied to the dot-com crash. So that's actually what got me interested in it. And maybe it's kind of embedded this this pessimism or something into my being as an investor. But because of that, all that to say that I've always been really interested in those events and that history behind it. And I agree that I think if you learn the history of the markets, you can at the very least learn what's gone wrong for other people, and then hopefully not repeat it. People say that history has a tendency to repeat itself. Well, you should at the very least try to avoid the obvious things that you've seen happen in the past. So on that note, when it comes to, again, retail investing, you run your own research platform, and you could argue that you kind of do so on an independent front. what are the different resources and kind of, whether it be data sets or whatever, that you have access to that you think investors need to have when they're investing themselves? Like what would be the base level of resources people should set themselves up with researching stocks? Are they fine just focusing on regulatory filings and kind of the public information? What do you find yourself works for you?
Well, what works for me is, of course, first time, because I do this full time, so I can do something that a person that has a job can't. And as for data resources, I find the best resources are annual reports and conference calls. Especially conference calls, when you cover a sector, then one company, one manager says something that impacts the other company, and then you understand better the sector. And if you dig into new entrants into the sector, you'll have all the publications in their presentations from all the research companies out there, from the McKinsey's, especially if you go with Canadian mining companies, all those prospectors, they have everything from McKinsey printed in their investment presentation. So if you just dig into companies and learn about the businesses, you can find all the data you need to know.
I think on the professional side, we have tools and things like that for researching companies, but at its core, a lot of that data is just dissected from those reports that you're mentioning. So truly, a lot of people do at the very least have access to that data, and it's for free. These are, when something's filed for a regulatory purpose for a public company, it's accessible online for everyone. And actually, on that note, I'll leave resources, links to where you can find such regulatory filings for companies. But a good point, and I think too, having the patience to go through an annual report or something like that, because they can be a bit tedious to get through. But
of course, there are some annual reports with 700 pages, which is insane. But over time, you start understanding where to go and what to go. And it's usually the first 20 pages that really gives a good explanation of what happened to the business over the last 12 months and what is likely to happen next. And then if you do that for 5 businesses that are in the same sector, you really have a good picture of the sector. One CEO says that prices in Canada have been lower, or production costs are lower there. Then you check the Canadian company. Oh, look, they have an advantage. And then you really start to understanding the balance of things and also the investment perspective there then, compared, of course, to the stock prices.
Right. I appreciate the Canadian example there. I agree. And I think, even most recently, the thing you probably see with all these regulatory filings is they're all touching about the COVID-19 pandemic and how that's impacted their business. So, these are things that are included in the regulatory filings that you can go through yourself and see. One thing I like too, actually, and this is actually usually one of the longer parts of the report, which is unfortunate. It's a lot of words, but I like to at the very least browse the risk section of these filings. So company management will at the very least list all the obvious risks and all the risks that they perceive you face as an investor for the company.
Even better, not company management, but the investment bank sponsoring the IPO or something will cover its own ass, and you will have all the risks in really, really nice detail. So everything that can go wrong, especially with new IPOs, read the risk, because the investment bank has covered its ass there with all the risk explanation. So that's an excellent example.
Yeah, that's a good point too. So at the very least, if nothing else, going through that section, like you mentioned, understanding the risks first. Again, it's usually a pretty long section because they go through almost everything they can think of. It's like they sit together and they just spitball ideas of what could go wrong. But at the very least, it's all written down and explained in terms of how they manage that risk and your exposure there that you can have access to. And I think, when it comes to reading annual reports and quarterly or whatever it be releases, and you mentioned transcripts as well, which I think is a good point. I think a lot of people from my understanding or from what I've seen, get their information kind of secondary from a news outlet or a news article. But there's really some value in going right to the source, because if you're reading a summary, there's always a chance that that summary will miss something or something like that.
And also, especially now with online and digitalization, the news is about clicks, is about getting you there and entertaining you with advertisement. It's not really about the news. It's more about producing as much content as possible, also on YouTube with videos and everything. Really, they force you to do as much to get to those clicks, not to really give good news with both sides, one and the other, etc. So that's really why we have to always look for our sources ourselves. That's the best way.
That's a really good point, and I'll actually let's pivot to that topic, because I'd be interested to hear your thoughts on the YouTube space, and we both have YouTube platforms, so I would hope at the very least we can assume that we enjoy YouTube and that it's a good platform for some stuff. But I think also with the retail boom, we have seen an increase in content that is like you said, sensationalized. Trying to convince viewers to click on the thumbnail, and this stock is going to crash or whatever it be, and things like that. How should investors kind of take that information? How should investors navigate that sort of content? And kind of what are your thoughts on the YouTube finance space as a whole?
Well, I think from, let's say, a positive side, it's educational. So a lot more people know now about stocks, about investing, about the stock market, about how it works. And also, if somebody does something shady, that will also immediately be, even in a few months, you will feel, okay, something is wrong, and their channel will slowly go down. So you will feel, are they selling something to me, either fear or sensationalism, or are they giving value to me in a way that they do it? So that's the main difference, and people over time feel it.
I'm a bit more cynical myself. I think some channels can survive doing some pretty shady things over time, but I certainly agree that at the very least.
That was with newsletters 20 years ago. They were would launch 50 newsletters. Of the 50, it's statistically that one will have 10 great buys, one after the other, and then just market that newsletter or something like that. And that just keeps on going, talking about the hottest stocks, talking about the stock went up, buying something and then it goes up or something like that. So that has been always there. It's not that it is now on YouTube. It has been there forever.
Right. And that's a good point. Yeah, I suppose it's you don't want to harp too hard on the YouTube platform when it's and even when you look at news stations and kind of the pundits they have come on and discuss individual positions, it's the same thing. It's people, hot picks and my top 5 and all these things that over time, you do probably see, how much of it is just fluff or at the very least just trying to grab your attention. So yeah, that's an interesting point. And I always like to pick people. I always like to pick YouTubers' brains about the YouTube finance space, because I think it's gotten a lot of love and hate from viewers. And I think some of the criticisms are justified, and it's a tricky space, I think is how I would say it, especially when it comes to things like stock picks and things like that. So on that point, I guess my follow-up would be, do you think YouTube is a good medium for learning about stocks and to a further extent for stock picks and things like that?
I think the biggest danger with YouTube is the YouTube algorithm, because it will serve you what you want to watch. So it might not give you an unbiased view of your learning path, but it will give you what you want to watch, what you have clicked, what you want to know more. And it's very easy that it leads you into thinking that's very, very, let's say, narrow or biased. So that doesn't give you a broad perspective. So when they ask me, Sven, what will happen? I say always, I don't know. I have no idea about the future. I have no idea what will happen. We can balance the factors and then see about the risk and reward, but I have absolutely no idea where will the stock market go in the next 1, 3, 5 years. It might double, it might crash 50%. And that's always, whenever I discuss, I put sometimes sensational titles, crash or this or that, but the answer of the whole video, just packaged differently, is always invest in businesses that will do good no matter what, and that you will be happy buying more. And that's what I also hope that people get over time from YouTube, that as they get burned here and there, that at the end they come to it, that it is about owning and accumulating businesses. But if we have a 10-year bear market, I think all our channels will be 10% of what they are now. So,
oh, probably, yeah. I wouldn't be surprised. Yeah, I think 2019 to 2020 was a very good time to start a YouTube channel, and you know, but like you said, we were in the longest bull run in U.S. history. So you know, it's will that repeat itself? We'll see over time. But
when I started in 2017, and I was thinking there is really nothing on YouTube, so why would I share my articles or my research on YouTube? Because nobody will watch it. YouTube is not for finance. So when I started, it was really nobody there, and now it's so hot, everybody's there. So it's really really interesting.
This is probably a question for the beginning of the interview, but what got you posting on YouTube? What was that motivating factor to start putting videos online?
So I was writing articles and research articles, and I was writing them for someone else. And of course, those were not my articles, so I could not republish them elsewhere. But I asked them, can I make videos on those articles that you publish on your site? And they said yes. And so I started talking a little bit just to test it, YouTube. So it started getting traction, and that's how I continued. Soon I quit the article writing and researching for somebody else and did my own.
And do it for yourself now. Yeah, it's like I said, it's funny how many stories are like that of people, you know, having some professional background in the space and then just dipping their toes into the online space and then having success, which is good to see. It's nice to see people with, you know, that kind of experience and insight to share doing well online. So I think we're kind of approaching, at the very least, the 45-minute mark. But before we kind of wrap up the conversation, I would just like to give you an opportunity to share kind of some final tips for investors. You know, we've talked about a lot of things in terms of what investors should look for and things like that. But if you had to, you know, summarize things at a high level to 1 or 2 key takeaways for, let's say, someone who isn't investing themselves yet but is interested in doing so, what would those takeaways be for them?
I was recently on vacation back in Croatia, and I met an old friend, and he has been a businessman for 35 years. He has no formal education, just high school. And he said he now accumulated about 7-8 shops, 2 laundry operations, and about 10 apartments over 30 years. So he's rich now. And he said, I don't understand much about numbers. I just know that if I invest in a property, I want my money back in 8 years. If it takes longer than 8 years, then I'm an idiot. And those words, I want my money back in 8-10 years, is something that summarizes for me what investing should be. You should have your investment options and saying, okay, is this investment, the business, returning me double the value in 8 years? And then you see, okay, if everything is expensive now, if it is 10 years, then okay, that's 7.2% per year compounded. And when you start understanding, okay, I'm giving my money in now, when and how am I going to get value on that money? That's the core of investing. Everything else, stock prices, is just entertainment for the short-term gambler that is inherent to our human nature. But investing is just boring boring, simple, okay, if I put my money in this, what do I get back from it? And that's it.
Right. I love that story. That's that's a great story, and one that would stick in your mind. And
immediately it eliminates, if we go to the second tip, it eliminates every risky thing. Because, okay, if I put my money there, can I lose everything in 5 years? If the answer is yes, forget about that.
Right.
Because if you lose your money, you're left with nothing. You're left with no compounding, with nothing. And that's value investing. First, focus on risk. What can go wrong? Do I like if it goes wrong? If no, then you say simply no, you go to something else. And if you don't find anything interesting to invest in, don't invest in anything. And that's as simple as that.
Great. Yeah, good, excellent points to end on. So Sven, thank you for joining me today. Guys, make sure to check out Sven Carlin's channel. It is Value Investing with Sven Carlin, PhD. He also has a site, svencarlin.com. Is there anything else you'd like to shout out in terms of socials or anything you'd like to share with viewers?
I think I really enjoyed the chat, and you might also, if you're interested more in modern value investing, you can check my book on Amazon, just Modern Value Investing, of course.
Awesome. Well, perfect. Thank you so much for taking the time today, Sven, and yeah, enjoy your weekend.
It was my pleasure.
Thank you guys for watching today. Cheers.